We were actually at a conference, an industry academic conference in Tucson, Arizona, and the phone rang about 4 in the morning, and I had not even been paying attention to the fact that this was about the time for the announcement. And, uh, and there was someone on the other end saying something with a bit of an accent, and there had been some fellow trying to get me to go give a talk in Belgium, I think, who seemed to have trouble with time zone differences, who'd call several times at odd hours, and I thought, oh my God, it's him again. And then I very quickly realized, no, it wasn't. And then I thought, well, it's somebody playing a trick on me. And then I very quickly realized it almost certainly wasn't. So after the call and jumping up and down and waking up Kathy, of course, we turned on CNN, and within about 5 minutes, the first announcement came, and it had about 60% of the information right. And then every 5 minutes, they repeated it, and it got a little bit more accurate, a little bit more accurate. So we called for room service and sat on the balcony outside our room, watched the sunrise over Tucson, and then all hell broke loose. I started as an undergraduate in a pre-med course because my mother wanted me to be a doctor, as so often the case. And then I switched to business at UCLA, and the first two courses were accounting and economics. And I hated accounting, and at least as it was taught in that course. And I loved economics. I didn't know anything about economics until I took the course. So I switched to an economics major, and then got a bachelor's and a master's in economics. I went into the service, and then when I came back, I was working at the Rand Corporation doing research, took the PhD, and in the course of that was working in finance with Fred Weston, and he introduced me to Harry's work, which I basically fell in love with. I thought this was just wonderful, beautiful stuff. So that's how I became conversant with the work. I started a dissertation on transfer pricing. Jack Hirschleifer came to UCLA, and since his work had been the key work I was starting with, it was decided he should be my chair. He looked at my, I thought about half-finished dissertation, and said he just didn't think there was much there. So I went to Harry, who was then at Rand, and said, is there anything maybe I could do building on some of your work? And in some sense, the rest is history. I started with Harry's work. Harry's work said, if you've got estimates of risk, returns, and correlations, here's how you should go out and build your portfolios. Very definitely normative. Here's how to do portfolio choice, as we call it today. And so in my dissertation, I started working with an algorithm. The first part of it, there were 3 pieces. First piece was an algorithm for solving that particular problem under the single index model assumptions in an efficient way. The second piece of the dissertation, again, was very much normative in tone, but it had a little bit of the behavioral to it. Through Fred Weston, I made contact with an investment advisor in Los Angeles, and he and I talked, and I said, well, you got to think probabilistically, and I said, can you, but he knew about bell-shaped distributions and such, so I made some grid paper, and I got him to draw some distributions for, I think, 30 or 40 stocks, and make some other estimates subjectively, and then I punched all that information on cards and processed it, and showed him what the implications a la Markowitz were of what at least his estimates were of the securities, and then asked him if he thought the portfolios that came out, which typically had something like 60% in something called haloid Xerox, were plausible portfolios, or if he felt there was something wrong somewhere, either with his estimates of prospects or with the assumptions that I and Markowitz had made to get to the portfolios. So that was the second part. And then the third part, I did what any well-trained microeconomist would do. I said, well, if everybody did what Markowitz said they should do, what does that imply for an equilibrium in capital markets? So the third part of the dissertation was basically positive in tone, looking at equilibrium. At that point, using the single index model as the maintained hypothesis about the way in which securities related one to the other. So I got the degree. Then I went to University of Washington, and I thought, well, this is really, there's some nifty results here. I had the capital market line, security market line, betas, the whole 9 yards. But it seemed hostage to this, very, very severe assumption about interrelationships of security returns. So I set about seeing if I could generalize. So that's basically how the CAPM in the published version came along. If you back off from the original, I like to call it the original CAPM because it was the first of many, many equilibrium theories dealing with risk and return broadly construed in capital markets, or more generally, I guess, the determination of asset prices and how asset prices relate to future probabilistic forecasts, trying to make it a little more general. But if you stand back and say, what were the two big practical messages that came out of that undertaking? One of them certainly, at least overly trivialized maybe, is diversify, diversify, diversify. Now, obviously, in that model, the formalism is hold the market proportions of risky securities and then lever up or down to suit your risk tolerance. But the idea of a broad portfolio in market value proportions as being very much an important and sensible investment strategy, that was sort of the first big message, I think you'd say. And the second was, yes, Virginia, there is a reward in higher expected return for bearing risk, but not just any risk. It's much more specific. It's the risk, to use a somewhat broader context now, of doing badly in bad times. Beta was obviously a measure in that particular mean variance context of doing badly in bad times. High beta securities tank in bad markets. And the idea was that it's not all risk or this kind of risk or that kind of risk, but it's that sort of central societal risk that in an efficient capital market is going to be rewarded with higher expected returns. So I think those were the two big messages. And the thing that's fascinating is as now we go to much more sophisticated, much cleverer, if you will, and much more detailed models of equilibrium, those messages keep coming through. Sure, there are variations on the theme, but by and large, at least 90%, those messages come through from theories that are much richer than the original CAPM, or for that matter, other mean variance models. Yeah, I think I was trying to avoid beta because, it is a scaled covariance,
Yes.
which is covariant, and that's the economics that drives it is the covariance. And, of course, that particular scale covariance is what you would call beta in a regression equation if you've chosen to label the things alpha and beta. And other folks were calling it beta at some point, and so I caved. I was trying to keep people focused on future, future, future.
Okay.
And so, yes, it is a regression line, but I wanted to emphasize it's a regression line fit to points, each of which is a possible future outcome, and the points carry with them probabilities, possibly, of those future outcomes. I was trying to avoid the trap that almost everybody, including off and on myself, fell into, saying, well, this is a theory that says if you look at historic measures of beta through statistical analyses of whatever sort, that will tell you something about not only historic average returns, but also future expected returns. And the theory doesn't say anything about the relationship between history and future prospects. The theory says something about expected future returns and future measures of covariance with the market or the newer theories are more general. I guess as I look back on not only my work, but other work that was done in that period, uh, I'm struck with how incredibly naive, I'll just speak for myself, I was about empirical work. The idea that somehow or other you could look at a swatch of history and look at average realized returns and think that those, were really good estimates of ex-ante expected returns was, as I say, if anything, extremely naive. Risks, correlations, history's not so bad as an estimate of the future risks and correlations, but average returns we now know, and I should have known then, are pretty awful indicators of expected returns then or a fortiori now. So I think we expected we could do a better job testing ex-ante theories using ex post data than we had any right to believe. And time, I think, initially it seemed as though, I think to most of the people who did those early tests, and I did only a very small number of them and did them very crudely, but it seemed as though we were getting a lot of corroboration for our theories, not only capital asset pricing model, but extensions of it and other theories. And then as time went on, we went through a period, I think, in finance of saying, as we used more powerful techniques, well, maybe historic data under those maintained assumptions that historic means are good at proxies for expected returns, maybe the historic data aren't as consistent with this theory or that theory. And now, hopefully, most people have understood that you've you've got to take historic data with a lot of grains of salt as a test of an ex-ante theory of any kind. If you take individual securities or even groupings of individual securities and look at relationships between historic average returns and historic measures such as beta, and expect that you're going to get a really crisp indication of what at any given time during that historic period the relationship was between ex-ante expected return and ex-ante beta, you're kidding yourself. I mean, you don't even have enough data to measure whether or not there was an overall market risk premium with any high degree of confidence, let alone go down to those minuscule levels. So I think, we expected, and some still expect, far more out of empirical work on historic results than the historic results can provide for us. There just isn't enough information there to sort out some of the subtleties. In 1986, I decided I'd been interested in the problems of pension funds, defined benefit, traditional pension funds, for many years, given seminars on it, worked with some pension fund people, and it seemed to me that there were some really interesting issues there, some of which could be helped by bringing to bear existing theory from finance, and others needed some new theory and new empirical work. And it became fairly clear to me early on, it wasn't very hard to figure, that what we needed was a single factor model with a reasonably parsimonious number of factors. So I thought initially, well, regression analysis, and let's regress the return on the manager, let's say, in a particular investment manager's portfolio, on the historic returns on the 15 factors, large value stocks, long bonds, whatever. And so I did that with some test data and got mostly garbage. Well, that's the end of that. So I thought, well, one of the reasons it was garbage, I was getting things like, well, this manager looks like it's minus 300% in treasury bills and minus 400% in small stocks and plus 900% in large stocks. And I know that that's not true. So what do we have as prior information to use when we do the analysis? Well, for most of those managers at that time, we knew that they had no net short positions in any asset class. Okay. Well, that's easy. Put lower bounds of zero. And in some cases, we knew that they had certainly no more than 50% in a particular asset class. If we knew that, we put an upper bound of 50%. So that was easy. That was a quadratic programming problem. I had quadratic programming algorithms lying all around the office for other purposes. So I started trying that with the data I had, and it turned out to be a very inexpensive, very easily implemented procedure, which could do a very good job, and it's good enough, I mean, to give you an indication, for some of the large pension sponsors with whom I still work, that technique is giving me out of sample, purely out of sample R-squareds, so no cheating, you know, in the high 90s. At the fund level, I'm not saying every single manager we get right, but at the fund level, I'm explaining a huge amount of the variation month to month in their performance. So it's really a very, very useful technique. It's not just the S&P 500, and it's not just the Wilshire 5000, and it's not just the U.S. stock and bond markets. There's a lot more there. Once you get to that point, to go back to some of our earlier discussion, you've got to think about an equilibrium in which there are French people and American people. There are Euro people and dollar people. So you need to think about a much more complex equilibrium in which people's positions have to do, among other things, not only where they live in the U.S., but what currency they tend to buy most of their goods in, what their consumption baskets are. So increasingly, we need to think much more broadly than the wildly simple capital asset pricing model, which assumed away huge swaths of the real issue. That being said, all theories assume away huge swaths of the real issue. The test of the theory, as always, is do you get enough of what really matters so that you've got something that gives you better decisions and better understanding than you would have had otherwise. And we've obviously come a long way since the original capital asset pricing model. Well, at that time, I did a couple of things. First, I would point them towards the most diversified equity mutual fund I could find and say, well, that's at least pretty diversified. And then a graph which forever I'm a little sad that I promulgated in the world, where you have risk, portfolio risk on the vertical axis and number of securities on the horizontal, and the graph goes down and flats out, and you can look at it and say, 20 is enough, 30 is certainly enough. And so I would make the argument that thing to do is to be as highly diversified as you can. And that kind of took care of the market portfolio aspect. In retrospect, of course, that graph is very deceptive because it assumes equal proportions and no industry factors, et cetera, et cetera. So it substantially overstates the amount of diversification you get from 20 or 30, and I think most of us would now say 20 or 30 isn't enough. And equal weighting isn't the right way to do it. But at that time, the idea was there's something that allows you to get tolerably close to a market portfolio, perhaps. And then on the borrowing and lending, you could certainly put money in the bank. It wasn't a great interest rate. You could certainly borrow on margin, although I'm not sure at the time you could do it for mutual funds. But these were all, and again, in some sense, it's the constant tension between a positive theory and a normative theory. We now know you can argue fairly convincingly, perhaps, the security market line argument, and you can argue that you ought to use the market portfolio, maybe with leverage of one sort or the other, or a proxy for it. But we certainly can't argue that people do the latter, because most people don't do the latter. So if you want to hold your positive theory up as a theory not only of asset pricing, but also of how people in fact choose portfolios, it obviously fails right out the chute. And it's much harder, as you know, and we all know, to convince students to adopt, say, perhaps the asset pricing aspect of the theory, even though the portfolio choice implications are clearly inconsistent with observed behavior. And so in my current work, where I build equilibria with people have different predictions, different this, different that, different the other things, it's in, what's interesting and what I think will be helpful to the extent people adopt this as a pedagogical device is showing how the asset pricing theory results can hold up even in a world in which people's portfolio choices are very diverse and only a minority buy the market portfolio. I currently believe that it is very helpful, at least to a first approximation, to assume that prices, asset prices, probably reasonably reflect publicly available information, semi-strong form. You don't have to hold to it, 100%, but 90% would be good. And so then you have to ask yourself, if at least for the bulk of my portfolio, I'm going to adopt the premise that prices reflect people's predictions, then what does that imply for what I ought to do? And the way in which I like to think about it now, people come to market with sort of generically what I call positions, your house, your job, with preferences, your utility function, and much more, if you're really trying to be broad about it, horizon, what have you, and then your predictions. And it seems to me that it's useful to counsel people to not make decisions based on predictions that are wildly different from those of, if you will, the average investor as reflected in market prices. I'm being very loose here. I've tried to be much more careful as I've written about this. But you live in Ohio, I live in California. You have one kind of income, I have a different kind of income. So there's no reason why we should be holding the same portfolio, even if we're four square with each other in terms of the predictions of the probabilities of different outcomes in the future. And so you need to take that into account. So that, for that reason alone, I'm not going to hold what you hold, and probably neither of us will hold the market portfolio. And similarly with preferences, I may have one horizon, you may have a different horizon. So there are all kinds of reasons, but the sort of the almost religious aspect that you should not expect to get something for nothing, and if you think something is wildly mispriced in the market, in an equilibrium sense, you may well be wrong. Here's this young person who's 30, or you said young, we'll call it 30, and has 100,000, and I really don't know much more about it. If you had said this is a person who is average in every respect, you'd go buy highly diversified, low-cost index funds, low turnover, low management fees, to give yourself exposure in those areas, and you do it in basically world market proportions at the time. The advantages of international diversification remain pretty substantial. They're possibly not as much as they used to be with globalization, although one can read those data in different ways. But there's still some pretty big advantages there. So I would think that home bias and the fixed income side for sure. On the equity side, probably not a lot of home bias, but at the end of the day, it really depends on your consumption bundle. It's a bit of a cop-out to say for an average person, a world market portfolio, because I've never met an average person. So you need to then say, all right, well, this person's younger than average. Maybe that involves a tilt with a little bit more aggressive a stance. But again, I'd like to know what the job is. Is this a person with tenure or a person who works in high tech in Silicon Valley? It makes a difference. This is a wonderful field, finance. I mean, it's just a marvelous field because it has some of the toughest intellectual problems that you can come up with, and yet it's got all sorts of practical applications. And to the extent that we can understand these things better, we can help ordinary human beings figure out how to arrange their lives so that they're as well off as they can be. So it's got social value, it's got commercial value, and it's got intellectual value. So it's a great field. So I've had a great ride in it, and I recommend it to whoever is watching.